What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. I'm going to be taking a break from discussing our top stock post over at Stocktrades.ca and relaying the research here in video. And instead, I'm going to speak more on a smaller cap Canadian stock that has gotten absolutely obliterated over the last week or so. And many people have kind of sent me messages, whether it be through email, on comments on videos, or through our premium platform, as to whether PayFare, which is the company that has, fallen over 75% over the last week or so, whether or not it's a buy. And I'm going to go over why it seems absurd to say that a 75% dip is actually not an overreaction right now, because it typically is, but considering the circumstances, I don't believe it to be an overreaction, and I'm going to discuss why, and I'm going to also discuss why you really need to be spending more time researching the equities you're going to buy and the stocks you're going to hold, because this company had some very glaring issues. I won't pretend like I knew these issues beforehand, because I did not follow PayFare all that much, but the issues would have been relatively well known had I dug into this company just a little bit. And I do believe this is actually a bullet that could have been very easily dodged by investors. Not necessarily a guarantee, but should have been a risk that should have been known and, either accepted or avoided. So with that said, let's jump right into the video and talk about what happened and what you can do to avoid the same situation moving forward if you did end up owning this stock and facing the big loss. So everybody, as always, before we start, head down below, like the video, subscribe to the channel. The more subscribers we get, the more likes we get, the more views we get, the more videos I can produce. Comment down below. Let me know if you owned PayFare, if you ended up taking this loss, if you're still holding today, and most importantly, drop a comment down below. Let me know what stock you want me to look into next. I am open to looking at absolutely anything. So PayFare, as we can come here, we can look at the chart. We can see that to say that it fell off a cliff is quite literal. The stock was trading at around $8.50 a share before plummeting down to $2 a share before having like a reasonable run up since 2022 bear market lows. I mean, the one thing about this company and just a plethora of other disastrous technology and just IPO companies period on the Toronto Stock Exchange during the pandemic, this IPO and subsequent run-up is probably not the company's fault. There was a ton of liquidity in the markets. Valuations were absolutely ridiculous. I don't really think PayFare did anything wrong by, hitting these peaks of $12 during COVID. It just happened to a multitude of companies. I believe there was something like 20 IPOs on the TSX, technology IPOs, and already 9 of them have been taken private over, the post-pandemic era, just highlighting the fact that, valuations were sky high during that time. They've, drawn down to absolute rock bottom in some cases, and these companies are just getting scooped up. That seems to be a strategy from PayFare now, as they have initiated a strategic review of the business overall, because, effectively, in my opinion, the loss of Doordash, they're kind of screwed in terms of, recovering a lot of this revenue. And why is that the case? Well, first off, I'm going to go over the actual issues with PayFare. So this is a company that relies mostly on the gig economy. So the gig economy being, let's say, DoorDash, food deliveries, Uber Eats, Lyft, all that type of stuff. So what this company aims to do is it aims to kind of bridge the gap between the people who operate in these gig economies, the Uber drivers. They provide kind of a payment solution so that these Uber drivers don't need to really wait all that long to get paid. So, rather than waiting for, a long drawn out bank draft from something like Uber, something like DoorDash, you can get paid right away using PayFare. They have things like, preloaded debit cards, some things like that, cashback rewards, just different stuff like this. So what is the first problem with a company like this? Well, first off, there are very few gig operators in the world. I mean, there just isn't. So especially here in Canada and the United States, I mean, think of how many large-scale gig economy stocks, companies there is. There's Uber, DoorDash, Lyft, all that type of stuff. But where else are you getting the broad diversity that you need in order to not be so focused on one client, which, as we're seeing right here, DoorDash decided not to renew its contract in 2025, which is the main reason why the company, the stock has gone from $8.42 to pretty much $2 in a matter of a few days. This company is hyper concentrated in a lot of larger gig economy stocks or companies, because it needs to be. There just isn't that many out there for the company to diversify its revenue base, and it really needs to rely on newer players in the sector to, diversify its revenue base. When in reality, companies like DoorDash, Skip the Dishes, Uber, Lyft, they hold such a dominant market share that it's very tough for new players to enter the industry and survive. So the company lost its contract with DoorDash. DoorDash makes up around 70 to 80% of the company's overall revenue. So the fact that the company fell 70 or 80% on the news is really not all that surprising, and it's really not all that much of a dip. I mean, if you think about it, if a company loses 78 to 80% of its revenue stream, and that revenue stream is not all that easily acquired elsewhere, and there's no short-term solution for that, a 70 to 80% fall in price is really not all that surprising. And the one thing I want to highlight is a lot of content creators are talking about how this stock might be cheaper now. I mean, if we look to this post here from the Motley Fool, can this undervalued stock make you a millionaire one day? So I mean, obviously the title's a little clickbait, but the one thing I wanted to highlight here, so they had mentioned that, the losing this contract, it's one of their big partners, but it's just a bump in the road. A bump in the road, the definition of a bump in the road is something that's not really a material issue. It's a minor inconvenience, and the company's going to get over it. This is huge. They just lost 80% of their business. This is not something that is going to be easily overcome. And again, I know I didn't really follow the company too long before this, and I know it's gonna sound like I'm saying you should have seen this coming a mile away, when in reality it would have been a bit difficult to navigate, but not impossible. You could have identified how big of a reliance this company has on DoorDash by just kind of paying attention to the MD&A and the quarterly conference calls. I mean, if we go to, I just pulled up an old conference call. This is from the fourth quarter of 2023, and the analysts are asking this company about the reliance on DoorDash and the reliance on Lyft, and they're asking questions, and this company, DoorDash or PayFare, comes right out and says, but in terms of aggregate net new users, obviously DoorDash is going to bring in the lion's share of the business. And if we go into the MD&A, the management discussion and analysis, we can see here they mention reliance on key clients. So our business is relying on clients with gig platforms operating in the gig industry in order to attract cardholders. There can be no assurance that we will be able to maintain our relationships with these gig platforms clients, or the relationships will result in an increase in cardholders. And then they mention right here, the majority of our cardholders are gig workers on relatively few gig platforms, and most of our revenues were derived from our top 2 gig platform clients, each of which have their long-term agreements coming up for renewal in the near or medium term. So, I mean, the company never really came out and said how long is left on their DoorDash contract. I couldn't find any data to say exactly, but when you have 2 main clients and the company is mentioning that their contracts are coming up for renewal in the near term, this is when you have to start asking yourself questions. What happens if that is not renewed? The company explicitly states here that these contracts are under no obligation. These gig companies are under no obligation to renew these contracts. And they said that they get the bulk of their revenue from 2 gig platform clients. What this should tell you as an investor is if one of these deals goes sour, doesn't get renewed, you are talking a material hit to revenue, and that is exactly what we've seen here. So although it was not blatantly obvious in the MD&A and in the quarterly conference calls, the company does not need to make it blatantly obvious. Obviously, they do not want to go out and publicly say, hey, we have DoorDash, which makes up 80% of our revenue, renewing in 2025. they're not going to, they don't want to say that. They're instead going to say, hey, we have a large concentration risk in 2 gig operators. One of those contracts is coming due in the near term. And for you as an individual investor, you have to start asking yourself more questions as to how, as to why, and as to the overall risk. And then from there, you can decide whether or not you want to buy that stock or not. It is up to you to do your own due diligence. And this company, the risks, again, they weren't blatantly obvious. I'm not going to come out and say and try to be smug and say they were blatantly obvious, but they were there. They definitely were there. They were fully available in the report, in the conference call. They mentioned their reliance on Doordash. In the risks in their MD&A, they mention, top 2 gig platform clients. It doesn't, take much consideration to probably extrapolate that one of these would be DoorDash. The other one is probably Uber because they are the biggest gig platforms arguably on, in North America. Now that we've gone over the fact that the company, it was heavily concentrated, it had a paper thin moat. I mean, it lost 80% of its business on one contract that hasn't been renewed. A lot of people are asking as to whether or not it is a buy right now. And overall, in my opinion, I do not believe that this company is much of an opportunity right now. So why do I feel that? Well, if we go back to the conference call, this company was, they were depending on a lot of DoorDash for a lot of their growth and a lot of their new clients. So it has lost that contract. So this is a company that is, it has been growing its free cash flow, it has been growing its earnings, and it has been growing its revenue at a very fast pace year over year. However, let's just say we adjust out the 80% loss. Let's just say we mark the stock down 80% and we're moving forward from here on out. That's what you should be doing, is deciding if it's a buy at $2 relative to the business it still has. And when we consider the fact that DoorDash probably caused a lot of this growth, it's likely that, Uber, Lyft, those other operators that it still works with, it's not going to be able to continue that level of growth moving forward. So the loss of this DoorDash contract is not only material from just a strictly loss of revenue standpoint, but is also material from, a forward growth projection. So one of the reasons that I feel this way is the company has mentioned a lot of the times that it has a lot of cash on the balance sheet and it has a lot of, ability to withstand the hardships moving forward. And, this commentary to me means that the company is probably not going to be profitable anymore. That's why they're speaking on their cash reserves and things like that. And they're going to need to, strategically, shift their mindset moving forward. So that kind of tells me that this company is going to go from free cash flow positive, $25.76 million in free cash flow, to likely burning cash in an attempt to, try to find other ways to grow. And the reason why I think this is probably highly unlikely is the fact that, like I said, there's really not that many gig operators that they can go to and acquire new revenue from. And another reason I feel like this company really doesn't have much of an economic moat to stand on at all is clearly DoorDash just found a better alternative. It just found, to me, this company, it's more so for the gig operators. So for the people who are running the Uber vehicles, doing DoorDash, doing all that type of stuff, this company more so provides a convenience for them. It doesn't really provide all that much of a convenience for DoorDash. If they find a alternative that is even reasonable, even a reasonable alternative, they can completely leave a company like PayFare, which is clearly what happened here. So, I mean, is there a chance that the company is discounted at these levels if they return to growth? I mean, maybe. The company has a market cap of around $108 million right now. And if we look on the balance sheet, they do have around $60 million in cash, I believe. And yeah, so, $55 million in cash and $261 million in short-term investments. I'm not exactly sure what the short-term investments are. But when we look to the company, $317 million in cash and cash equivalents, whereas they trade at a market cap of, $100 million. So this company, does have an enterprise value, a negative enterprise value, but I'm just kind of wondering whether the market is pricing in the fact that they're going to be burning a lot of cash right now. And overall, they've kind of entered a strategic, they're looking at selling the business, a strategic overview. And to me, this kind of seems like relatively poor timing. You're issuing a, strategic overview of the business and looking to entertain a merger or an offer once your stock price is down 80%. It kind of seems a bit desperate to me. And it kind of, makes me feel like the only avenue for growth that this company did have was Doordash, and that is pretty much evaporated right now. And there's going to be, a bit of cash burn moving forward and a bit of restructuring, probably, a lot of spent capital trying to get this business back on track. So that is why we're seeing it trade at 100 million market cap, despite having, 300 million in current assets. But overall, do I feel this company is a buy right now? No. And do I feel that it's probably a good lesson in terms of, for investors to do a little bit more due diligence before buying equities? Yes, I know it's a pretty harsh lesson to learn. And, a lot of this stuff is unavoidable. It's stuff you cannot foresee. That's just the risk of buying individual equities. But again, this concentration risk on Doordash, it would have been known to you. You could have identified the concentration by paying attention to the earnings calls and to the MD&A. So this was not a systematic risk, like a general broad market risk that you generally can't avoid. This was certainly something that with enough due diligence, you could have avoided. So again, I don't really think it's that big of an opportunity. A lot of Canadian tech IPOs and just IPOs in general have been really, really messy coming out of the pandemic. And ultimately, this is just a casualty of a company that really doesn't have any economic moat at all. It has no incentive for a lot of these larger companies to maintain the business. They're ultimately going to look for the best possible route to go in this regard, and that could be a company that charges less than PayFare does, anything like that. It doesn't have any sort of moat to protect its underlying business, and there's only 4 or 5 major players in North America that it can derive revenue from. So everybody, hope you like the video. Head down below, subscribe to the channel, like the video, comment down below, let me know your thoughts on PayFare. Are you buying it after the 75% dip? Especially because, it's got a lot of cash and receivables for a $100 million market cap, or are you avoiding this one just because of the overall business it lost? And again, let me know what stock you want me to go over next in the comments, and I will see you next time.